Welcome back, listeners. We will start with chapter number 11, which is current liabilities and payroll accounting. It has two learning objectives to be covered. We'll be talking about what are current liabilities and how to record them. And then we'll be talking about different reported issues regarding the current liabilities. Starting with the definition of current liabilities, that how do we define them, or what is a proper definition of current liability? It is a borrowed stuff, or you can say it's a loan, or it's a debt that a company is supposed to pay back within 1 year or operating cycle. Now, which one we will choose, either 1 year or operating cycle? So the rule says whichever is longer. If, for example, the company's operating cycle ends in 14 months, then we will be choosing the lifespan for the current liabilities 14 months, not 12 months, which is 1 year. So all those liabilities in my examples, which will be maturing in a time period of 14 months, we will classify them as current liabilities. What are the types of current liabilities, or you can say what are the examples of current liabilities? So mostly notes payable, which matures in shorter period of time. Then we have accounts payable. Then we have unearned revenues and some sort of accrued liabilities like taxes payable, salaries and wages payable, and interest payable. Starting with notes payable, you will also find this concept when we will discuss long-term liabilities. But remember, those notes which matures within the definition of current liabilities, like 1 year or operating cycle, whichever is longer, so we classify them as current liabilities. But if the life is greater than the operating cycle or 1 year, then in that case we classify them as long-term notes payable. So notes payable, as their name says, that they are notes written. So they are written promises made by the borrower to the lender that he will be paying money back to the lender. Usually, they are issued to meet the short-term financing needs because they are shorter in nature, notes payable. So in that case, they are helpful in meeting the short-term financing needs of the companies. And we mostly want the borrowers that they have to pay interest on these notes. There is no specified time period for short-term notes payable. They could be for 3 months, they could be for 6 months, 9 months, depending upon the condition. We have example here which will explain the concept of notes payable. So First National Bank agrees to lend, means to give $100,000 on September 1st, 2017 if Collie William Co. signs $100,000 12% 4 months notes maturing on January 1st. So this sentence have many information. Number one, the lender is First National Bank. Number two, the borrower is Colivilian Company. Number three, the money borrowed is $100,000. Number four, the money was borrowed on September 1st, 2017. And number five, the life of these notes are 4 months. So all these information will be helping us in classifying this note as shorter because the life is 4 months and its interest bearing 12%. So let's start looking at the requirement or the instructions, what we have to record. So number one, part A, prepare the entry on September 1st. So what happened on September 1st? The borrowing happened. So Coley William Company, they have borrowed money. So they received cash and they signed the notes payable. Point number, let's do this. So cash gets debit 100,000 and notes payable gets credit 100,000. Point number B says that prepare the existing entry on December 31st. So the existing entry is relevant to interest because it's shorter period of time, so we'll be paying interest along with the money which we have borrowed all together. Interest plus money, both of them will be returned on 1st of January. So if we are recording interest and we are not paying it, so it becomes a liability. So let's do the calculation. 12% is the rate of interest. The borrowed money is 100,000. So 100,000 multiplied by 12%, it will give you annual interest expense. But from September 1st till December 31st, 4 months are there. So we will not take the interest expense of full months, we will take only for 4 months. So we will multiply it with partial year factor, which is 4 by 12. And by simplifying this calculation, we will get interest amount of 4,000. So what we are going to record, interest expense 4,000. We are not paying now. Kole will pay it on January 1st along with the payment of note. So it will become interest payable. Moving on towards the third requirement for this question, prepare the entry at maturity. The maturity was on January 1st, 2018, means the money was returned as well as accrued interest was returned. So both of them, notes payable, which was money borrowed, now we are returning it, so we'll debit notes payable. Interest payable liability will also get debit because we are returning it, and cash will get credit together for 104,000. Moving towards the second category of current liability, which is sales taxes payable. These taxes are paid by the companies to the government, and they earn these taxes or they collect these taxes from the customers. So when they sell their products, there is a margin of sales tax on the product, which is paid by the customer. Company receives the payment of the product from the customer as well as sales tax, which becomes a liability for the company because company has to return this money to the government authorities. The sales taxes are expressed as a stated percentage of the sales. So we can say 5% sales tax, 2% sales tax. It is a percentage of sale price. So if the product price is 10 and the sales tax is $2%, so we'll take 2% of 10. Okay. So who collects this sales tax? Selling company or the retailer who sells the products to the customer, he collects this. Collect tax from the customer. Enter tax separately in the cash register or include it into total receipt. Now there are two ways. When you collect the sales tax from the customer, either your software or your ERP records it separately. When I say separately, it means that separate sales tax amount is recorded from the sales revenue. Or the second way is it is recorded in the sales revenue, means its complete amount which we are collecting, which includes the sales price plus the sales tax. And in that case, we have to extract it out from the full collected receipt so that we can remits the collection to the State Department of Revenue. So wherever tax you collect, you have to remit it to the State Department. Let's look at this example. The March 25th cash register reading for Kole Groceries shows sales of $10,000 and sales taxes of $600. So it means if the 600 is the sales tax collected from the customer, 600 for 10,000 is 6%. They have already calculated it for us. So the journal entry on March 25th, the Kole will record they collected the cash not only for their product as well as they also collected the sales tax. So together the cash which they have collected, that is 10,600. At the same time, we will also record sales revenue. Sales revenue is only for 10,000 and the 600 is sales tax payable which should be paid back to the government. That's why it's a liability for the company. Sometimes companies do not enter sales tax separately in the cash register. So if this is the case, then we have to extract the amount. So there is procedure, or you can say steps, to extract the sales tax out of the full cash receipt. So let's look at this example. Kole Grocery enters total receipt 10,600 because the amount received from the sale is equal to the sales price, which is 100% plus 6% of the sales tax. So how do we record this journal entry now? So cash is collected 10,600. We have to record sales revenue, but now sales revenue is not clear. We have to extract it out. So if full receipt is 10,600, sales tax percentage is 6%. So we will divide 10,600 with 1.06 so that we can get our sales revenue value. So 10,600, which is total cash received, divided by 1 plus sales tax percentage, we get 10,000, which is sales revenue. And the remaining, which is sales tax payable, that is difference between cash collected and the sales revenue. Because remaining money which you have collected, that is for sales tax payable. Another category of current liability is known as earned revenue. When the companies collect the revenue from their customers in advance and they have not rendered the services or they have not delivered the products to the customer, this revenue is not earned according to the revenue recognition principle. So that's why companies cannot record the revenue though they have collected the proceeds. So this revenue becomes a liability for the company until and unless company delivers the product or render the services to the clients. So revenue received before the company delivers the goods or provides the services, this revenue is known as earned revenue because you did not earn it yet. We have few examples like airlines. Always customers book the tickets first, pay the tickets price, then they travel. So the time period until the customer do not travel, this ticket revenue remains earned for the company. So earned ticket revenue, and it will become ticket revenue when the customer will travel with the airline. Same is the case with magazine publishers that you have to subscribe for the magazine first for annual subscription or monthly subscription. Once you subscribe, you pay the money to the company, though you have not received the magazine yet. But once the company or the magazine sells you the product or they give you or they deliver you the magazine, then they can record this unearned magazine revenue or unearned subscription revenue as their subscription revenue. Also, if the hotels they ask you for advance booking, then in that case the rent they have collected from you, that will be unearned revenue, and that will become rent revenue when the customer will use the room. We have example over here. Superior University sells 10,000 season football tickets. 10,000 tickets they have sold at $50 each. So each ticket cost $50 for its 5 game home schedule. There are 5 games for which they have made a schedule or schedule. The entry for the sale of season tickets is, so firstly the tickets are sold, then the matches will held. So how many tickets? 10,000 tickets. 50 is each ticket price. So total money which is collected by the Superior University, that is 500,000. 50 multiplied by 10,000. But this is not their sales revenue. This is their earned ticket revenue. Now 5 games are scheduled. So each one game will be over, revenue will be recorded for 1 game. Second game will be over, second game revenue will be recorded, and so on. This 500,000 unearned ticket revenue is for 5 games. So each game revenue is 500,000 divided by 5, that is 100,000. So as each game is completed, Superior will recognize its revenue. So for example, on September 7th, first game is over. So unearned ticket revenue, which is current liability, it will be finished because now 1 game unearned revenue becomes a revenue because the game is already over. So unearned ticket revenue gets debit and ticket revenue gets credit. So liability is reduced and revenue is recorded. Companies also record the current maturities of long-term debts as their current liabilities because the part of the long-term liability which is supposed to be paid within a year, that will be classified as current. Rest portion of the long-term loan will remain in non-current liabilities. No adjusting entry is required for this case. Wendy Construction issues a 5-year interest-bearing $25,000 note on January 1st, 2017. This note specifies that each January 1st, starting from January 1st, 2018, Wendy should pay $5,000 of the note. When the company prepares the financial statement on December 31st, 2017. So, few information is available. Number one, the note interest bearing note life is 5 years and the amount is 25,000, and the note was signed on January 1st, 2017. Now, the company, Wendy, who has borrowed this money and signed the note, they have to pay installments. Each installment will be paid on January 1st, and the first installment is due on January 1st, 2018, means within a year. So 5,000, which is due on January 1st, 2018, it's current. Remaining out of 25,000, 5 is current, so remaining 20,000 is payable after 1 year. Means after the second year, third year, fourth year, and fifth year. So they are non-current. Only 5,000 is current. Look here, what amount should be reported as current liability? The amount which is due within a year. So means the amount which you are supposed to pay on January 1st, 2018, that is 5,000. And then what amount should be reported as long-term liability remaining out of 25,000? So remaining is 20,000. We have a do it exercise. You and several classmates are studying for the next accounting examination. They ask you to answer the following question. If cash is borrowed on $50,000, 6 months, 12% note on September 1st, how much interest expense will be incurred by December 31st? The life of the note is 6 months. The borrowing happened on September 1st. So September, October, November, and December, 4 months. This 12% is always annual until and unless the word monthly is mentioned. So let's calculate annual and then extract 4 month interest out of it. So 50,000 is the amount borrowed, 12% is the annual rate, but we only need for 4 months because from September 1st till December 31st, 4 months are over. So 4 by 12. So interest which is due, that is $2,000. Second part is how is the sales tax amount determined when the cash register total includes the sales tax? Means the same classmates are asking some question about the sales tax. That if the sales tax amount is not recorded separately, full proceeds are recorded, means the proceeds for the revenue as well as for the sales tax, then how you're going to extract it? Few minutes back we just discussed about it, that we will divide our total proceeds with 1 plus tax rate, and whatever amount we will get, that will be revenue, and then from the total proceeds we will subtract the revenue, so we will get the sales tax amount. So I wrote the same for the solution, two steps procedure. Another question is, if 15,000 is collected in advance on November 1st for 3 months rent, what amount of the rent should be recognized by December 31st? The unearned rent revenue is collected on November 1st, but it's for 3 months, 15,000. So per month revenue is 15,000 divided by 3 is 5,000. So they want us to know how much rent revenue will be by December 31st. So the revenue for the November month and December now month will be recognized. It will be no more unearned rent revenue. So 5,000 plus 5,000, 10,000 will be recognized as rent revenue. Let's talk about reporting uncertainty, which is learning objective number 2. Uncertainty means that for these liabilities, company is not certain that will they happen, and if they will be happening, how much amount will they have to pay. So they are known as contingent liabilities. Contingent liabilities are the potential liability that may become an actual liability in the future, but we are not sure. There is a probability, there is a chance that they may become. So there is three level of probability. We are probab. We are probable means we are very sure that we have to pay this liability in the future. Reasonably possible means that a big percentage is there that might be we have to pay this liability in the future. Remote means we are uncertain. We are not sure. Probability is very less. So what we are going to do if we are probable about a liability, if we think that it's reasonably possible, and what if it is remote? If we are probable, then in that case we will record it like an accrued liability, and we will also mention it in the footnotes of the financial statements. Reasonably possible will be mentioned in the footnotes, and remote will be mentioned as ignored because we are not sure. Very less probability is there. Let me give you some percentages. Maybe if you are above 80% or 90% sure that the liability will happen, so it is accrued. We will accrue it, payable, we will make it. Reasonably possible means above 50% surety that the liability will happen. And in that case, we will mention it in the footnotes, and remote percentage is very less. A contingent liability should be recorded in the account when it is probable that the contingency will happen, but the amount cannot be reasonably estimated. It is reasonably possible the contingency will happen and the amount can be reasonably estimated. It is probable that the contingency will happen and the amount can be reasonably estimated means we can calculate the amount, and it is reasonably possible that the contingent liability will happen, but the amount cannot be reasonably estimated. If we cannot estimate the amount, how can we record the liability? And we said that we will put it in the account, we will make it accrued if it is probable. So choice number C is the answer because we can estimate the amount, also it's probable. We have example of contingent liability. The most common example of contingent liability is product warranties. Especially when we purchase electronics, companies provide us warranties for those electronics. So these warranties are the contingent liabilities for the companies. There are promises made by the companies or the sellers to the customers or to the buyers to make good on a deficiency of quantity, quality, or performance in the product. Means they say that we will be taking care of if the product is having deficiency in quantity, means the full quantity you don't receive, or its quality is tampered, or the performance of the product is not as we promised, then we will be taking care of your losses. So estimated cost of on how to record this product warranty. So we will see that what is the cost for the company to meet this claim of the client. So estimated cost of honoring the product warranty contracts should be recognized as expense in the period in which the sale occur. We don't wait for the customers to claim and then we record our liability or expense. No. As soon as we sell the product, we estimate how many products could come back as the warranty claim. And based on that, we record our warranty expense and possible warranty liability. We have example over here. Denson Manufacturing Company sells 10,000 washers and dryers at an average price of $600 each. So 10,000 products are sold and each product sale price is $600. The selling price includes a 1-year warranty on parts, means Denson promise if a part is deficit or a part is broken, we can replace that part, but not the full product. Denson expects that 500 units will be defected. How many they sell? They sell 10,000. They estimate that 500, which is 5%, will be defected. And the warranty repair cost will average $80 per unit. So 500 units they expect that they might come back, and in order to repair one unit on average they have to incur the cost of $80. So this is our estimation for the warranty expense. In 2017, the company honored warranty contracts on 300 units. How many we expected? We expected 500. But how many they came back? 300 at a total cost of $24,000. This is what actually happened. So firstly, let's calculate the estimated warranty on December 31st. So how many units were sold? 10,000. 5% will be defective, we estimate. So that is 500 units. In order to fix one unit, company might incur $80. So 40,000 is the estimated warranty liability. Make an adjusting entry. So warranty expense gets debit and warranty liability gets credit with the amount we have calculated as estimated product warranty liability. Prepare the entry to record the repair cost incurred in 2017 to honor the warranty contracts on 2017 sales. Look here, how many they came back 300 and the cost incurred was 24,000. So let's record this warranty liability because out of 500, 300 came back, so warranty liability gets debit and repair parts gets credit because parts they have to arrange. Assume that company replaces 20 defective units in January 2018 at an average cost of $80 in part and labor. Means they have to repair the parts and the labor cost. 20 defective units. So let's arrange for this. Warranty liability will further decrease because now 20 more units are defective. So 20 80 is per unit correction or repair cost. 80 multiplied by 20, that is 1,600, and repair parts will get credit. This is how we present the current liabilities in the balance sheet. If you see under the liabilities and owner equity section, current liabilities are appearing. All of them, these red marks are the current liabilities. And this is it for the discussion of chapter number 11. Please subscribe to the channel if you want to listen to the upcoming videos. Soon I will be uploading them. Take care. Bye.